Fed Chair Powell appears open to a slower pace of monetary tightening, and equity markets like it. Back in October, Fed Chair Powell had suggested we're a long way away from neutral at this point, neutral interest rates being the point where monetary policy is neither helping nor hindering the economy. That much more hawkish tone from the Fed chair helped send US bonds sharply lower, with 10-year yields pushing above 3.2% early October, and combined with trade war concerns, equity markets into a tailspin which saw the S&P drop more than 10% from peak to trough through the month. Now, the merest hint at the Economic Club of New York on Thursday that we're just below the broad range of estimates of the level that would be neutral for the economy was enough to spark a strong bounce in the S&P, and US bond yields briefly dipped below 3% for the first time since mid-September. To be sure, the Fed and many private sector economists are forecasting continued solid growth, low unemployment, and inflation near 2%, so it's clearly the case that rates will continue rising at a gradual pace. Westpac is forecasting rates will rise in December, and this will be followed by further rate hikes in March, June, and September too. However, market pricing now suggests that the Fed will hike in December and only once more after that, suggesting traders are expecting a very benign outcome from the Fed indeed. With the Fed chair speech out the way, attention now turns to the key G20 meeting in Buenos Aires this weekend. Expectations are high that Trump and Xi will emerge with some sort of agreement on trade from a private dinner scheduled on Saturday evening. However, positioning from the US administration has been unsupportive of this view. The US Trade Representative released a 55-page report last week detailing how China appears to have taken further unreasonable actions in recent months, and this week announced fresh moves to examine all available tools to equalize the tariffs applied to automobiles by China. This investigation is over and above the Commerce Department's Section 232 auto investigation that was launched in May of this year, with the final report due in March next year at the latest. The US Trade Representative move represents an escalation of trade actions ahead of G20, and it's a clear indication of how high the bar is set for any agreement between the US and China to be possible. Despite this, the more upbeat tone for equity markets, lower US yields, softer US dollar, and a much improved tone in emerging markets has helped the Australian dollar to a 3-month high in the last few days. This has been despite a sharp fall in iron ore prices to 4-month lows just below $65. Westpac's not expecting this strength to last too much longer, with a drop to 72 by year-end and 70 by mid-next year, our forecasts. Now, next week brings a heavy run of data and risk events in Australia. We've inventory data for Q3 on Monday, an important input into Q3 GDP. Tuesday sees the RBA policy meet, where policy will of course be unchanged, but commentary on housing will be closely watched. Wednesday brings Q3 GDP, where Westpac expects to see 0.7 on the quarter and 3.4 on the year, with some downside risks due to softer construction work done data. And then Thursday caps off a busy week with merchandise trade and retail sales. It's busy around the world too. The US ISM, a key gauge of manufacturing in the US, will be released Monday. Fed Chair Powell testifies on the economic outlook before Congress's Joint Economic Committee on Wednesday, and the key US non-farm payroll report is released next Friday. OPEC meets in Vienna Thursday, with crude prices down 33% from the October highs, and a series of Brexit debates are scheduled for the House of Commons from Tuesday next week as May faces her biggest challenge, the meaningful vote on December 11. These are all factors we'll talk about in next week's Markets Update.